One of the most successful investors of all time, Warren Buffett is known for his long-term investment strategy, his focus on strong companies, and his ability to identify unique investment opportunities. Although it is not easy to replicate his success, we will show you some of the key principles that Buffett uses in his investment strategy. Principle 1. Invest in companies you know. Investing in companies you know is a key principle in Warren Buffett's investment strategy because he believes it is easier to make informed decisions about a company when you have a deep understanding of its business model and sector. Buffett often invests in companies he knows well and has a personal connection with, either through the industry he worked in or through his everyday life experience. For example, Buffett invested in Coca-Cola because he loves drinking Coca-Cola and understands the beverage business well. Investing in companies you know can also help you avoid impulsive investments in low-value companies. If you don't have a good understanding of a company or its business model, it's harder to determine if it's a good long-term investment. By investing in companies you know, you can be sure that you have a deep understanding of the company and its business model. However, investing in companies you know doesn't mean investing solely in companies you have a personal connection with. It's important to conduct thorough research and understand the fundamentals of the company, its position in the market, its competition, and its long-term growth potential. Principle 2. Look for companies with a durable competitive advantage. A durable competitive advantage is a characteristic or set of characteristics that makes a company unique and allows it to maintain its position in the market and generate long-term profits. It is what sets a company apart from its competition and enables it to maintain its competitive edge. Buffett believes that investing in companies with a durable competitive advantage is important because these companies are more likely to generate consistent and sustainable long-term returns. In addition, companies with a durable competitive advantage are less likely to be affected by competition or external factors such as market price fluctuations. When evaluating a company, Buffett looks for indicators of a durable competitive advantage. Some examples of indicators of a durable competitive advantage include: brand. A strong and recognized brand can help a company maintain its position in the market and increase its customer base. Distribution network. A well-established and efficient distribution network can help a company reach new customers and markets. Technology. Unique and advanced technology can give a company an edge over its competitors and help it maintain its position in the market. Economies of scale. Companies that produce on a large scale can reduce their costs and increase their efficiency, allowing them to offer more competitive prices and gain market share. Buffett also pays close attention to the quality of a company's management. He believes that good management is essential to the long-term success of a company, and that poor management can destroy the value of a company in the long run. Principle 3. Don't get caught up in market trends. Buffett believes that most investors get caught up in market trends and lose sight of the underlying fundamentals of the companies they invest in. Investors often focus on stock prices and market fluctuations rather than the real value of the companies they invest in. Buffett is famous for not following market trends and being a long-term investor. Instead of trying to make predictions about the market, Buffett focuses on fundamental analysis of companies and looks for investment opportunities that are undervalued compared to their real value. To avoid getting caught up in market trends, Buffett advises investors to focus on the following strategies. Invest in what you know. As mentioned earlier, Buffett believes that investing in companies you know and understand is key to long-term returns. If you're not sure about an investment, don't do it. Analyze companies in depth. Buffett believes that most investors don't analyze companies well enough and focus too much on market trends. It's important to analyze the companies you're considering investing in thoroughly and understand their underlying fundamentals. Be patient. Buffett is famous for his patience when it comes to investing. Instead of seeking quick profits, he waits to find long-term undervalued investment opportunities. Don't try to make market predictions. Buffett doesn't believe it's possible to predict the market and therefore doesn't rely on market predictions when making investment decisions. Instead, he focuses on the fundamental analysis of companies and finding investment opportunities that are undervalued compared to their real value. Principle 4. Look for companies with a high return on capital. Return on capital, ROC, is a measure of how efficiently a company uses its capital to generate profits. Buffett considers ROC to be one of the most important measures for evaluating the quality of a company and its ability to generate sustainable long-term profits. Buffett prefers to invest in companies that have a high and sustainable ROC. These companies can generate high returns in the long run and are therefore a good investment for him. In addition, Buffett prefers to invest in companies that have a high ROC compared to their competitors in the same sector. If a company has a high and sustainable ROC compared to its competitors, it means that it has a lasting competitive advantage in that sector. Buffett also pays attention to how a company uses its capital. If a company has a high ROC but uses a large part of its capital to pay dividends or buy back shares instead of reinvesting in its business, it may be a signal that the company has no growth opportunities or is not using its capital efficiently. To apply this principle to investing like Warren Buffett, it is important to research and analyze the ROC of the companies you are interested in. You can do this using financial analysis tools like Excel spreadsheets or analysis software. When evaluating a company, you should pay attention to the company's ROC and how it compares to its competitors in the same sector. It is also important to consider how the company uses its capital and whether it is reinvesting in its business or paying dividends and buying back shares. Principle 5. Look for companies with a strong management team. Buffett believes that a company can only be successful if it has a strong and competent management team. He looks for companies that are led by honest, intelligent, and hardworking people who have a clear vision and a solid strategy for long-term growth. Buffett not only seeks strong leaders but also leaders who have a significant stake in the company. He often invests in companies where the management team has a large amount of stock in the company, as this indicates that the management team is motivated to maximize the company's value. In addition, Buffett prefers to invest in companies that have a proven track record of success and have been effectively managed for a prolonged period. He looks for companies that have a history of sustainable growth and have demonstrated their ability to adapt to market changes. On the other hand, Buffett also values transparency and open and honest communication from a company's management team. He looks for companies that are transparent in their operations and communicate clearly and effectively with their shareholders. When evaluating a company, it is important to research and analyze the management team. This may include reviewing the backgrounds of team members, their past success, and how they are currently managing the company. It is also important to evaluate the ownership of stocks by the management team and their motivation to maximize the company's value. Now that we have covered the 5 key principles of Warren Buffett's investment strategy, here are some additional tips to help you invest like him. Tip 1. Do your homework. Warren Buffett's first tip for successful investing is to do your homework before making any investment decisions. For Buffett, investing is not a game of chance, but rather making informed decisions based on knowledge and understanding of the company and the market it operates in. Before investing in a company, Buffett recommends dedicating time and effort to carefully research and analyze the company, its industry, and its competition. This can include reviewing financial reports, analyzing market trends, and reading relevant news and articles. It is also important to understand the company's strategy and vision, and how it is positioned in the market. Does the company have a sustainable competitive advantage? Does it have a track record of growth and profitability? How does it compare to its competitors? These are some of the questions you should ask yourself when analyzing a company. In addition, Buffett recommends focusing on investing in companies that you understand and are within your area of expertise. If you do not understand the business or industry well, it is best to avoid investing in it. Instead of investing in anything that comes along, it is better to be selective and only invest in companies that you know and understand well. Once you have done your research and analysis, it is important to make informed decisions rather than impulsive ones. Buffett often patiently waits for opportunities to invest in solid companies at reasonable prices, rather than making quick and hasty decisions. Tip 2. Maintain a long-term mindset. Warren Buffett's second tip for successful investing is to maintain a long-term mindset. Unlike investors who seek quick profits, Buffett believes in investing in solid companies for the long term and patiently waiting for their investment to mature over time. Instead of worrying about short-term fluctuations in the stock market, Buffett recommends focusing on the quality of the company and its potential for long-term growth. This means investing in companies that have a proven track record of growth and profitability, and that are well-positioned to succeed in the future. Buffett also recommends maintaining a long-term mindset when it comes to selling decisions. Instead of selling stocks as soon as there is a small drop in price, Buffett recommends carefully evaluating the situation and considering the long-term performance of the company. If the company remains solid and has long-term growth potential, then it is probably worth holding on to the investment. A long-term mindset also involves resisting the temptation to follow market trends or to try to make a short-term investment. Instead of seeking quick gains, it is better to focus on building a solid and diversified portfolio that can offer long-term gains. Buffett is an advocate of investing in high-quality companies and holding on to them for the long term, as demonstrated by his strategy of holding stocks in companies like Coca-Cola and American Express for decades. By maintaining a long-term mindset, investors can reduce risk and maximize long-term profit opportunities. Tip 3. Don't let emotions take over. Warren Buffett's third tip for successful investing is not to let emotions take over. Instead of making decisions based on fear or euphoria, Buffett recommends staying calm and carefully evaluating each situation before making a decision. The stock market is notoriously volatile and can be very emotional for investors. When stock prices rise, investors may feel euphoric and tempted to invest in anything that seems to be generating profits. On the other hand, when stock prices fall, investors may feel fear and sell their stocks, even when the underlying company is still solid. Buffett believes that the key to avoiding these emotional mistakes is to maintain a long-term perspective and focus on the fundamentals of the company. Instead of being swayed by the short-term fluctuations of the market, investors should focus on the quality of the company and its long-term growth potential. Buffett also recommends avoiding the temptation to make radical changes to the portfolio in response to market fluctuations. Instead of selling all their stocks in a company when prices drop, Buffett advises carefully evaluating the situation and considering whether the company is still solid and has long-term growth potential. In addition, Buffett recommends avoiding market fads and trends. Instead of following the crowd and investing in the latest trendy company, investors should focus on companies with solid fundamentals and long-term growth potential. Tip 4. Diversify your portfolio. Buffett believes that it is important to have a well-diversified portfolio that includes a variety of companies in different sectors and markets. Diversification helps to minimize risk by avoiding an investor having all their eggs in one basket. If a particular company or sector begins to have problems, the investor will still have other companies and sectors to rely on. However, Buffett warns that diversification does not simply mean having a large number of shares in different companies. Instead, he recommends having a concentrated portfolio of companies that you know and understand, but that also spans different sectors and markets. In addition, Buffett advises against over-diversification, which is when an investor has so many shares in their portfolio that they cannot closely follow each company. Instead, Buffett recommends having a concentrated portfolio of around 10 to 20 companies that the investor knows and understands well. Although diversification can help minimize risk, Buffett believes that the true success of investing comes from investing in quality companies at attractive prices. While diversification is important for minimizing risk, it should not be the only consideration when building an investment portfolio. In summary, Warren Buffett's investment strategy is based on solid and fundamental principles that have proven effective over time. It is important to remember that investing is not a game of chance, but a serious activity that requires time and effort to do well. Successful investing is not just about finding the next hot company or following market trends. Instead, it's about investing in solid companies that have a durable competitive advantage, a strong management team, a high return on capital, and a deep understanding of the company and its sector. In addition, you should consider Buffett's tips for successful investing, including doing your homework, maintaining a long-term mindset, not being swayed by emotions, and diversifying your portfolio properly. By following Buffett's tips and principles, you can make more informed and wise investment decisions, and build a solid and sustainable investment portfolio. Although it may require patience and dedication, long-term investment success can be achieved by following these solid principles. Thank you for watching this video, and I hope you have learned something new today. Feel free to leave any questions or comments in the comment section below.